on the one hand, the labor market has been the bright spot of the advanced global economy. The fact that labor markets are so strong has supported consumer spending, but the labor markets are not responding in the traditional way to central bank policy. They're not breaking under the pressure of higher interest rates. In fact, in some countries, they're accelerating and they're staying strong, staying resilient. Good news, supporting consumer spending. But the question for every central bank now is how are we going to lower inflation if the labor markets are not responding in the traditional way? Is it through the housing market? Is it through the credit market? We've seen some progress there, but inflation is sticking around much longer than central bankers had expected. And I'll go a step further. This is not a one and done, even in the current inflationary period. There's every expectation to think that bouts of inflation will be more persistent and frequent than they've been over the past 10 years. So what is the game plan from central banks, not just once inflation is down now, but into the future? How does the central bank respond to these pressures that keep prices growing?
I wonder if this takes us to the unpalatable option, unemployment. You know, effectively in the past, when you've seen real change, genuine change in consumption patterns, it's because the unemployment rate's gone up. And we've often spoken in the past that the Fed has to break something before it stops hiking. Does it actually need to break this tight labor market by driving up the unemployment rate?
The Fed is betting that they can lower inflation down to the 2% target without a meaningful, like a strong increase in the unemployment rate. So we're talking
the Goldilocks scenario.
Exactly.
Right.
Maybe getting up to 4.5%, maybe 5%. They think that's tolerable. There's enough slack in the labor market that you still keep a relatively strong labor market where people can find jobs. Might take longer, may not be their first choice, but there is some kind of opportunity in the system, but still keep inflation down to 2%, because the argument they'll make is inflation is bad for workers. And that's what we see in our results, that you have to expect higher salaries just to keep up. So the number one problem from the central banker's point of view is getting inflation back to 2% target. Now, the question is, can they do it, and how long will it take?
You make the absolutely spot-on point about the inflation of the last 10 years. In fact, I'll go as far as to say the last of this century, compared with the bouts that you would have studied as a chief economist at ADP. And 74 to 82, pretty much two bouts of inflation within that period. It took about 8 years to tame it, what have you, and we were in the early years of the Reagan era before we did as well. People have had 2 to 3 years of inflation this time round. They're not ready. The markets aren't ready for the long haul. I mean, I wonder if you get this question a lot about, is the market in, and my words, cloud cuckoo land compared to, given what you just said about the longevity and the stickiness of inflation?
I think the markets have been very optimistic about inflation.
Okay.
And that's because inflation has morphed. It's not the same inflation. The DNA has shifted out of the pandemic from being supply shock driven and supply chain driven to being service sector driven, and that feeds right back into wages. Wages are the bridge between the labor market and inflation. And the wages that we're seeing, the growth that we're seeing right now, is not consistent with 2% inflation. And that is the hard part for the Fed. So the easy part was at the beginning, when the supply chain easing really helped push down goods prices. The hard part is in the service sector, where we're seeing inflation be more persistent. And how they deal with that means it really translates to what happens to the unemployment rate. So it's much more impactful to consumers this way.